From factory floors to Wall Street, the manufacturing sector is truly a barometer and a reflection of our economy now more than ever. We're going to show you how the manufacturing sector is acting as a barometer for our overall economy in two key data sets. First off, Empire State Manufacturing Index was reported this morning at a level of negative 6.0, following last month's negative 15.6. You can see we've actually been in negative territory for quite a while. We're going to show you how significant that is. The manufacturing sector is in recessionary territory. We don't say this just to evoke emotion, but rather very objectively. We can see the current level, -6. It's the seventh consecutive negative report within Empire State Manufacturing. Line this up with historical data. The last time we had 7 consecutive reports, well, not the last time, but the first time in the '08 recession occurred between January and July of 2008. That was certainly followed by much deeper recessionary territory. Now, this doesn't mean we're going to fall into recession in the overall economy. We have a good jobs number last month. The CPI is declining to an extent. So other barometers of the economy look good. But when we talk about manufacturing, we're in negative territory, and 7 consecutive negative reports is not something I think to take lightly. Now, we can see here in particular, Empire State Manufacturing, that's in orange. And now the orange histogram bars show us the period of time between 2006 and 10. The white dotted line shows us where we are now. So where we are now in -6 territory, that lines up with the shallow negative territory we saw in the beginning and the midpoint of 2008. Now, the deep part of the recession, we saw negative numbers near -20, -30. -6 isn't awful, but it's not positive either. Now, manufacturing as an economic barometer, let's talk about inflation. Inflation has hit manufacturing hard. Now, these are the different sectors within the Empire State Manufacturing Index that was reported this morning. In particular, note we have prices received 7.1, prices paid 24.5. Now, it's very self-explanatory. The prices received are the prices that the manufacturers receive from the customers, from us. Well, not directly, but when we go to the store, we buy something, the store buys those goods from the manufacturer. They're paying a level of 7.1. The higher the number, the more money they're receiving. 7, it's in positive territory. It's not great. But the manufacturers are forced to pay 24.5 on the index. That's much higher. So they're paying a lot more for the raw materials than they're collecting. The consumer, you and I, we're already kind of spread thin, so to speak. So we really can't afford that much more. But the manufacturers, they don't have that flexibility. They have to pay very inflated prices. So in terms of inflation, it's really squeezing the manufacturing sector hard. We can see here in orange, that's the Empire State Manufacturing prices paid. In blue, prices received. The prices received level is lower. Now it is trending lower. The inflationary pressures are subsiding. Unfortunately, the prices received, that's the net money that the manufacturers receive for the goods that they produce, is less than what they're paying for the raw materials. On a year-over-year basis, we look at the CPI and PPI. What's the correlation? Why are we now talking about CPI and PPI? Because it's a loose comparison. In blue, it's consumer price index. In red, producer price index. But it's the same, sort of angle that we're looking at the economy. In terms of consumer prices, that's what we pay as the consumer. But the producer price index, that's the level of inflation, the measure of inflation that the producers pay. And we can see that the consumer price index is higher. We, as a consumer, are paying more than what the producers are paying to manufacture the goods. Now, that's good. I mean, the manufacturers need to make a profit. Otherwise, they all go out of business, and then jobs are lost, and then there's no manufactured goods. But the trend is a little bit troubling because we can see over time, the CPI, we know last month's report was 3.3. Prior to that was 3.4. It's kind of steady. but the producer price index is rising. So the level of inflation at the raw material level is rising. It's squeezing the profit margins. If you imagine the difference between the blue and the red bars here, that's the profit margin for manufacturers. Now, manufacturers, we don't want to feel bad for them. They make a lot of money, but we should, in a sense, because their profit margins dictate how much they can pay in salaries, how much they can expand. When we see those profit margins shrink, when that red bar goes up relative to the blue bar, that's not good. And we're going to show you why. Because now this affects manufacturing as an economic barometer in terms of jobs. We know that the profit margin is being squeezed, producer prices are going up, the consumer can't pay anymore. Well, take a look at the manufacturing sector in terms of these two measures. The number of employees down 8.7, the average work week down 9.9. Is it any surprise that when we see the profit margins being squeezed, the manufacturers, well, they have no choice. Their backs are against the wall. They have to cut the number of employees. They have to cut the average work week. Also, with consumer prices higher, we as consumers can afford less. So therefore, the manufacturers don't need as many employees. They don't need to pay for as long of work week, so to speak. So we can see here in blue, Empire State Manufacturing, that's number of employees. In red, average work week. And then we have a steady downtrend. The number of employees is decreasing. The average work week is also decreasing. Now, what's the correlation? Here in blue, Empire State Manufacturing, number of employees. In red, labor force participation rate. This is attached to our last jobs number. And we can see a pretty strong correlation. When one line goes up, so does the other. And is it any surprise that as the Empire State Manufacturing Index goes down in terms of the number of employees, well, that's correlated to the labor force participation rate, the number of individuals within the labor force. So we like to take a look at the data and dive a little bit deeper beyond the surface to really try to get a sense of what's going on within the economy. We did so just a few days ago in our recession forecast. We really tried to dive deeply, looking at the heat maps, compare where we are now historically to where we were in the 2007 through 9 recessionary period. And I think that you'll find what we discovered here to be quite interesting.